In this section, we're going to discuss funding, and I am going to warn you now that this is going to be one of the longer sections because there are so many resources out there. I wanted to make sure that I took the time to actually go through all of these. Now, I'm not going to read verbatim what everything is saying on the screen, but I am actually going to go into a few of these types of funding. So, we have self-funding, funding from families and friends, bank loans, crowdfunding, angel investors, venture capital, small business association or administration loans, grants, factoring, and microloans. Now, I am going to touch on self-funding, business loans, crowdfunding, venture capital, and grants. So feel free to move forward to the section that you are most interested in, but I highly recommend if you do have the opportunity or the chance to listen to this whole video, that you do. Again, I am going to be reading these slides to you, so feel free to put your phone down and just listen to this, or while you're driving, because I want to make sure that you are able to listen to these videos in its entirety without really kind of interrupting your schedule. So let's jump right into self-funding. So self-funding means that you yourself are going to fund the start of your business. And this can take a while, so it might delay the start of your company if your upfront costs are, more than you may be able to contribute. I started most of my businesses while working in 9 to 5, so I was able to funnel my my salary into the startup costs of my businesses, and this might work for you as well. So things to consider when, determining if self-funding is right for you is going to be develop a comprehensive business plan. Again, a business plan is really important. We'll discuss that in one of the later lessons, but a business plan is a critical tool for any business, and it's especially important when self-funding. So a comprehensive business plan should include detailed description of the business, its products or services, target market, competition, financial projections. So when you're putting together a business plan, it's really going to make you think about the ins and the outs of your business, where you need to actually pay for things. And honestly, one of the only ways to do this in a way that doesn't leave out too much is to develop a business plan. Next is going to be to manage your cash flow carefully. So when self-funding a new business, managing cash flow is critical. It's important to have a clear understanding of the business's operating expenses and revenue streams, and to have a plan for managing cash flow to ensure that the business has sufficient funds to operate. So in the beginning, you might have to buffer, right? Your company might not be profitable right off the bat, so you might actually have to take money out of your paycheck, possibly, but we'll get into some other ways that you can get around that. Prioritize expenses. So prioritizing expenses is an important part of self-funding a new business. It's important to focus on expenses that are critical to the success of the business, such as marketing and product development, while minimizing non-essential expenses. So this really is going to be up to you, and I'll give you an example. When I first started my fitness company, I wanted to paint the sky with this company. I loved everything that I was doing. I'm extremely passionate about it, and I still am. But I went way over on my marketing budget, and I had to pay a lot of that out of my pocket. So those are the sorts of cutbacks that you can make, but marketing is a tax write-off. So keep that in mind. You do have the ability to make that a deduction. Next is going to be build a strong network. So building a strong network of contacts, including suppliers, customers, and industry professionals, can help a new business succeed. Networking can also lead to new business opportunities and partnerships. And here's my recommendation. There's an analogy of, fetching water before you're thirsty. So you want to build these relationships before you actually need these people, because the last thing any successful business owner wants is someone coming to them and asking them for things. So if you know of a successful business owner, or if you have something that Russell Brunson called the top 100, so you're, who you want to be, what entrepreneur out there do you want to emulate? You want to establish these relationships with them and see if there's any way that you can help them, right? What value can you provide them? How can you plug into their already existing business? In a way that you can leverage that later, so it is a mutual benefit. They are going to know that you're helping them, and they're going to see how well you're doing. And what they will do, and what all business owners do, is if they can help you later down the road, they will, because everyone in the business industry knows how important these networks are. And I'm going to give you another example. When I was in the military, I served with a guy who wasn't everybody's favorite. He was somewhat difficult to work with, but I was always nice to him because I thought maybe he was maybe going through some things at home in his personal life. So I wanted to make sure that instead of kind of like rolling my eyes at him like everybody else did, that I was a little bit nicer. When he got out of the military, he opened up a supplement company that is now one of the most successful supplement companies in California. And he remembered me, and he remembered how nice I was to him. But before he opened his supplement company, he had been reaching out to me and asking for information because I was his only real connection here in California. And he opened his business, and now when I opened my fitness company, he actually promoted me without me even asking him because I fetched water before I was thirsty. I didn't intentionally do this, but these are the types of networks that you can leverage. Next is going to be focus on revenue generation. So when self-funding a new business, it's important to focus on generating revenue as quickly as possible. This means adjusting pricing or product offerings to meet customer needs and maximize revenue. One of the biggest mistakes I see is, new entrepreneurs will mark their prices, products, or services way too high. And don't get me wrong, you are worth it. You should definitely mark your prices to what you think you're worth. But here's the thing, you need to deliver 10 times the value. And I'll give you another example. I wrote the Entrepreneurship Guide. That book is the ins and the outs of opening a small business. It is 10 times what I charge, meaning I only charge that book is only, $20, but it's worth $300. And that is because you want to provide 10 times the amount. Now this course, if I think about all the time that I'm putting into this, not just these videos, but putting the course together and just how passionate I am about that, if I were to sit down and figure out how much time went into this, how much money I pay myself per hour, this course is well over what I charge. This course to me provides a value of $5,000 and more because I'm taking what I would normally charge an individual, maybe a couple $1,000s, and I'm putting it into a course that's now worth $5,000. So you want to provide 10 times the value. So if your product is the same price as everyone else's out there, that's great. Because the other thing is you don't want to be the cheapest product. And being the most expensive does have its perks. However, as a marketing strategy, you want to make sure that it's going to, your target audience is going to be able to actually buy or, buy your product and service. So it gets very, it's very tricky when determining pricing. So market research will help you determine this. While you're doing your market research, you should be looking at the costs of things. If you're going to sell a t-shirt, if I'm going to sell a $40 graphic tee, what do the other $40 graphic tees look like? What do the $100 graphic tee look like? And what does the $10 graphic tee look like? And it might not be the look of it, it might be the customer service, it might be their website, it might be the level of marketing that they're doing. These all things determine the price, and it's very apparent to a customer, the value of that product based on the effort that you put in as the owner. Last thing is going to be planning for growth. So while self-funding may limit the initial growth potential of a new business, it's important to plan for future growth. This may include developing a plan for expanding the business's product or service offerings, entering new markets, or hiring additional staff. Definitely plan for growth, and definitely keep that in the back of your mind as your long-term goal, which you can absolutely put into your business plan. And what you want to do is you want to bridge the gap. Where are you now? Where do you want to be? And what are the steps you need to take to get there? These steps are your business's plan. And every year or quarter, depending on your industry, you want to make those finite adjustments. Okay, so next let's talk about business loans. So there are a few different types of business loans. You have your traditional bank loan. Traditional bank loans are a common type of small business loan. These loans are typically secured by collateral and require a strong credit score and business financials. So most banks won't give you a business loan right off the bat, and if they do, it's going to be based on your own personal credit. A general rule of thumb is a credit score of about 640 and above. Not everybody starting a business has that type of credit score. I know I didn't, that's for sure. So a traditional business loan wasn't an option for me. However, go to your bank, talk to them, and find out what they can offer you, especially if you're going to be banking with them. Next are going to be small business administration loans, so the SBA loans, which are government-backed loans that are designed to help small businesses that may not qualify for traditional bank loans. SBA loans offer low interest rates and longer repayment terms than traditional bank loans, and they can be used for a variety of business purposes, including working capital, equipment purchases, and real estate. So working capital is going to be, paying for your regular expenses. Now, the Small Business Association, I believe right now, the credit score requirement is somewhere in the 500, so a little bit lower. And another thing with the traditional bank loans is that sometimes they require your business to be in business for a certain amount of time, 3 years usually. Small business loans are not the case. They actually do have loans specifically for startups. So if you head to their website, I believe it's sba.gov, you'll be able to check out the different loans that they offer. And yes, the repayment plan is over a very long course of time. Lower interest rates. Overall, you're going to pay back a lot more, but it might be a little more feasible when you're first starting out. Next are going to be equipment loans. If you are starting, let's say, a construction company and you need like some serious machinery and equipment, you might want to take out an equipment loan. Again, these are going to fall under the other nuances of the other loans, credit score, things like that, might not necessarily require your business to be in business for a certain amount of time. But if you're looking to take out a smaller loan, so get an idea of how much the equipment is going to cost you. So you might want to start off by buying used equipment to keep that cost lower, but it depends on your credit score and how much you're willing to pay off, because those equipment loans generally the repayment starts right away. Lines of credit are actually really great. They are flexible type of financing that can be used for a variety of business purposes. With the line of credit, the borrower, so you, can draw on the funds as needed up to a certain credit limit. Now, there is interest charged on the amount of funds that are actually drawn. So if you have a $4,000 credit limit, but you only take out $1,000, you'll only pay interest on the $1,000. And some lines of credit are flexible. So if you have a $4,000 credit limit, usually the interest rate's a little bit lower, and every time you pay it off, you can go back. So if I took out $1,000, I pay off that $1,000, I'm back at $4,000 that I could take out, and it continuously rolls. Whereas a business loan, once you pay it off, and you have to reapply. Line of credit kind of works like a credit card. Invoice financing is a type of accounts receivable financing. It is a type of financing that allows businesses to borrow against their outstanding invoices. Now, this is going to be like your net 30s. There are some suppliers that will actually finance you. So you would actually have to talk to your supplier and see if they offer invoice financing. Uline does this. They have net 30s and sometimes up to net 90s. And you can talk to them. And sometimes they do require a little bit of a fee just to protect their investment. But invoice financing is another option. So next we're going to talk about crowdfunding, which is one of my favorite forms of funding. Okay, so let's talk about crowdfunding. And the reason why I love crowdfunding because it's such an ingenious idea for raising funding. So crowdfunding is when you raise a small amount of money from a large amount of people. So if you start a crowdfunding campaign on a website like Kickstarter, even GoFundMe has crowdfunding campaigns. So you go on there, you create a profile, you tell people about your business, and it doesn't have to be a new business if your business is trying to grow. It's not to save your business, so I want to mention that real quick. If you're trying to grow, introduce new product, new service, if you are a brand new company, so you go onto Kickstarter, you create your profile, and you brag about your company, you brag about you brag about why this is going to be the next best thing. And what happens is the millions and millions of people that are on Kickstarter, like I'm on Kickstarter, I contribute to businesses all the time. These folks that are on Kickstarter or on these crowdfunding websites will contribute. And it might not be a lot. It might be $5, it might be $20, it might be $100. But when you're getting $5, $10 from thousands of people, potentially millions of people, most people surpass their goals. And it's a true testament to really validate your business. So there are a few different types of crowdfunding. One is going to be donation-based crowdfunding. So this is a type of crowdfunding where investors donate money to a project or cause without the expectation of receiving anything in return. So this is just them donating, and I've done this. This is an option on Kickstarter. Reward-based crowdfunding is a type of crowdfunding where investors receive a reward or product in exchange for their investment. The reward can range from simple thank you notes to tangible products. So here's an example. I love to go camping, and I've been looking for a really good camping knife because I like to chop up vegetables and actually make a fresh meal when I'm in the backcountry. And I didn't want to bring a big, butcher knife. Where the heck am I going to put that in my bag? So I found this guy. He started it's a foldable knife that you can take out into the backcountry. He's a professional chef. So when he launched his Kickstarter campaign, what he actually did was everyone who contributed a certain amount, he sent you one of their prototypes. So that is what a reward-based crowdfunding campaign is. Then there's equity-based crowdfunding. I don't really recommend this, but equity-based crowdfunding is a type of crowdfunding where the investors receive equity in the company in exchange for their investment. This type of crowdfunding is typically used by startups and early-stage companies to raise funds from a large pool of investors. I don't really recommend this in the beginning. You don't want to give up any equity just yet. And there aren't too many platforms that offer this. This is more of like an angel investor type situation, except it's going to be a smaller percentage that you're giving them. And there's debt-based crowdfunding. So debt-based crowdfunding is the type of crowdfunding where investors lend you money and receive interest on their investment. This type of crowdfunding is typically used by companies or products that need short-term financing. So just like taking out a loan, except this individual is lending you the money without maybe running a financial, credit check. Okay, so next we're going to talk about venture capital. So venture capital is when it's for any type of business, but it's really more so if you are going into an industry like I see a lot of tech companies where they'll reach out for angel investors or venture capitalists to invest in their business because their business is going to eventually make a ton of money. And it's hard to project that, but if you're looking for funding and you go to a venture capitalist who are usually like millionaires that are looking to contribute some money, it's honestly the concept of Shark Tank. And they're like, this is an amazing idea, I want to give you the money. That means that they know that this business is going to be profitable. And there are websites where you can do this, just like Kickstarter, where you can set up a profile, kind of plead your case, and then investors will actually reach out to you. I think there's angelinvestorsnetwork.com. So it's a high risk, high reward. So venture capital is a high risk, high reward form of funding. Venture capitals or VCs invest in early stage companies with the hope of earning significant returns on their investment. However, the failure rate of startup companies is high, and VCs expect to lose money on some of their investments. Not to scare you, because it's not going to be you. You're doing everything that you need to do by taking this course and making sure that your business is set up for success. But 50% of small businesses fail in their first year. The 50% that do make it to the second year now have a 60% chance of failing. And the same percentage goes for the third, fourth, and fifth year. If your business can survive 5 years in business, there's an 80% chance that it will stay in business. That is a scary statistic, but the reason I find that this statistic exists is because a lot of people start their business and don't do the research. They don't take the time to sit through a course like this, which this course is to tax write-off. So it's like, there are all these assets and resources and things out there, but some people don't know that they exist. So they start a business and they don't do very well. So that is where that statistic comes from. At least that's what I've pulled from the research. So going back to venture capitals, there's also long-term investments. So venture capital investments are typically long-term, which with an expected holding period of several years. Venture capitalists can stay on to your company as long as they want. You would have to buy them out, and that gets into the equity of ownership. So venture capitalists invest in early stage companies in exchange for equity ownership, typically in the form of stocks. So they're going to own a certain percentage of their company, and that percentage, if you ever watch Shark Tank, is going to be based on the valuation of their company. Now, if you're just starting off, it's going to be kind of projected numbers. So if you're asking for $100,000, but the venture capitalist agrees with your estimation that your company's worth $6 million, they might say, okay, you want $100,000, your company's worth $600,000, I'll take, $6 million, I'll take a 6% equity stake in your business. So that is kind of where the negotiation comes in with the venture capitalist, because you can actually negotiate, but you have to legitimize it. You can't just say my company is going to be a $6 million company. Why is it going to be a $6 million company? You don't want to say because the tech industry is $1 billion industry. That's cool. But how many people start small businesses in the tech industry and fail? What makes your business different? That is what they want to know. Some venture capitalists have an active involvement, and you might want this. If you're going to someone who's looking to invest in your company who is doing very well and has other businesses in the industry that you're trying to enter, or has a business that is complementary to your business. So if you're looking to start a beverage company and this happens to be a venture capitalist who owns a bottling facility where they can bottle the product, that's great. So they might have an active involvement, but not all venture capitalists do. They might trust you that you're the subject matter expert and they just want to write you a paycheck. Again, selective investment criteria. Usually when you set up a profile in these accounts or you go to talk to a venture capitalist, they're going to want to see your business plan. They're going to want to see your portfolio, and they're going to rip it to shreds, right? They're going to have, their attorneys there, their tax attorneys there, and they're all going to sit down and look at your business plan. And they're going to make sure it makes sense. And if it doesn't, you have to be ready to answer those questions. Another thing is an exit strategy. Some venture capitalists just want to come in, give you a check. They want to make a ton of money, and then they want to leave. This exit strategy is going to be built into the agreement sometimes. Sometimes I've seen exit strategies where they're actually negotiable or not always applicable. So if a venture capitalist just really loves the company and doesn't want to leave, they have that option. So some exit strategies are optional. Okay, so the next thing we're going to talk about and the last thing we're going to talk about is grants. Okay, so business grants are a type of funding provided to small businesses and startups by government agencies, foundations, and other organizations. Unlike loans, grants do not need to be repaid, so they're extremely valuable. There are a ton of organizations out there, Coca-Cola, Walmart, they all have nonprofits, and those nonprofits generally write grants to small businesses. So doing this grant search is going to take you into the deep, dark realms of Google because every big business has some sort of grant program. So I would type in Coca-Cola grants, Pepsi grants, whatever is out there, and a lot of them target a certain demographic. So some of them might provide grants for women, some of them might provide grants for minorities, some of them might provide grants for minority females, right, or minority women. So you really have to go out there and do the research. There's also government grants. Now, government grants they're pretty common. They're given by the federal, state, local government agencies, some tribal. These grants are used for a variety of business purposes, including research and development, workforce training, and equipment purchases. So the first thing you want to do when you're trying to set up a government grant is you need to go to grants.gov. Grants.gov will walk you through the process because you need to get a SAMS account, and that SAMS account is going to give your company a code. You're going to take that code, go to the grants.gov website, plug that code in, fill out your company information, and then you can start applying for grants. Next are going to be foundation grants, which I already talked about. These are going to be organizations that, like I just mentioned, big businesses, and some of them are what are known as corporate responsibility. So this is going to be, if Coca-Cola has factories that are generating smoke all across the United States, they might set up a nonprofit to help with the environment, to be like, hey, sorry, we're doing this, sorry about our emissions, but we are pouring a ton of money into protecting the environment. It's supposed to cancel each other out, but I'll leave it at that. So if your company is going to be doing anything that has some sort of sustainability efforts behind it, even if you're a nonprofit or starting a nonprofit, you might want to look into those grants as well. I know the Lego Corporation has a huge grant program because they're looking for sustainable products to replace the plastic that they're using for their toys. Okay, so next are going to be corporate grants, and these are the ones that I talked about. I kind of went backwards on this list, but corporate grants are, again, going to be grants provided by corporations as a way to support small businesses and nonprofit organizations. They can be used for a variety of reasons, and again, the corporate grants are generally for a specific, underprivileged community. So, there were tons of entrepreneurs when I was growing up in the South Bronx that had community outreach programs that would provide grant funding to after-school programs. Or, there are tons of grant programs out there for veterans. So you really have to look into the different organizations. And I would start with your industry type. So if you're going to be an electrician, you might want to look at, Schneider Electric. Do they have any grants available for small businesses? If you're going to be, opening up a beverage company, take a look at all the big hitters, right? So Coca-Cola, Pepsi, whoever, Mars, whoever else. So that's kind of where you're going to start your research there. So again, these are all the different types of funding. Kind of going back to the first slide, you have self-funding, family and friends, so it's essentially getting money from your family and friends, bank loans, crowdfunding, angel investors, which are kind of like venture capitalists, small business administration loans, grants, factoring, which I didn't really talk about. That is when you give it's when you sell your accounts receivable. So I don't want to get into that too much because that is definitely like a last resort. And then there's microloans. These loans sometimes come from nonprofit organizations as a way to help your business, but they are also have really high requirements, and a startup sometimes doesn't actually qualify. So again, that's funding. I hope this helped. I would recommend looking up the different type of funding in your area. Even look at your local businesses, because they, a lot of local businesses try to build up the community, and to do that, they try to provide funding to businesses in the area.